You're welcome back, traders. You're welcome back to the Forex Geek channel. In this video, we are just going to be diving into a strategy that can help you take advantage of one of the most powerful forces in the Forex market, and that is none other than volatility. Volatility is very important when it comes to the Forex market, okay? So that is right. We're going to be talking about volatility expansion strategy, okay? So have you ever noticed how markets can remain calm and quiet only to suddenly burst into action? I believe you must have noticed that if you're an active trader, okay? Now, this strategy is actually designed to help you anticipate those explosive movements and position yourself to make the most of them. All right. So we're just going to be covering what volatility expansion means, how to identify key moments, and how to use tools like Bollinger Bands, ATR, and Keltner Channels to execute your trades. Okay. So stay tuned, grab your notebook, and let us get started. And don't forget to like this video and subscribe for more trading insights and strategies. Now, before we get into the strategy, let us just talk about volatility real quick, okay? In simple terms, volatility measures how much the price of an asset fluctuates over a certain period. All right? So, when volatility is low, prices tend to move in narrow ranges. All right. When volatility is low, prices tend to move in narrow ranges. But when volatility expands, we often see big sudden price movements. For example, it is obvious that we had a low volatility around this zone, right? You can see that this was a low volatility zone, right? You can see how the price was moving within a narrow range, right? But then suddenly we had a burst in price activity, and we can see how the price quickly surged, and within this zone we can see how we had an expansion in volatility. We can see how we had increased volatility within this zone. So this is a low volatility zone and this is a high volatility zone. All right. Now, this is where the volatility expansion strategy comes in. Now, the goal is to identify when the market is transitioning from low to high volatility, so you can catch those major price movements early. All right. Now, these periods of expansion often coincide with breakouts, trends, or significant market events. Okay. Now, let's just talk about the tools that you'll need for this strategy. Now, there are three main indicators that we're going to be using. All right. And the first is the Bollinger Bands. All right. We're going to be using the Bollinger Bands. Okay. So here we have the Bollinger Bands indicator. Okay. Now, the Bollinger Bands measure volatility by showing how far prices deviate from a moving average. Okay. So basically, when the bands contract, like what we had here, it signals low volatility. Okay. And then when the bands expand, right? When the bands expand, it signals increase in volatility, right? It signals rising volatility. Now, another indicator we're going to be using is the average through range. All right. Average through range indicator. That is the ATR. So this is the ATR indicator, the average through range indicator. This measures the average price range over a specific period. Okay, so a rising ATR suggests increase in volatility. As you can see what happened here, you can see that as we had an increase in volatility around here, you can see how the ATR rose. Okay, so this could lead to price expansion when you have the ATR rising. And finally, we are going to be using the Keltner channels. Okay, so I'm going to add the Keltner channels to the chart. Okay, so this is how the Keltner channels look like. You can see that the Keltner channels are actually similar to the Bollinger Bands. Okay, now these channels are based on the ATR. All right, they help identify breakout zones during periods of expanding volatility. Okay, now these tools are easy to add to your trading platform, and they'll be a guide to spotting volatility expansion. Now let us move on to how you can apply the volatility expansion strategy in your trading. Okay, here's a simple step-by-step process. The first is to identify a period of low volatility. Okay, so you look for contraction in Bollinger Bands or a flat ATR, like what we had here. We had a flat ATR, and we also had, the contraction in the Bollinger Bands, right? Now, these are signals that the market is consolidating and preparing for a move. Okay, and then secondly, you wait for a breakout. So you watch for the price to break above or below key levels, such as support, resistance, or the Keltner channels. All right. Now, this breakout confirms the start of volatility expansion. Okay. So after that, you can go ahead to enter your trade. Once the breakout has been confirmed, you can just enter your trade in the direction of the breakout. In this case, you can consider entering a buy trade. And then you set your stop loss. Okay, you can place your stop loss just outside the consolidation range to protect yourself from false breakouts. Okay, and then you ride the expansion. Use trailing stop loss. Okay, use trailing stops or predetermined take profit levels to maximize your gains as the volatility increases. Now, to make this strategy even more effective, here are some additional tips. You can actually combine, these indicators with other indicators. You can actually decide to use multiple indicators if you wish. All right, just to confirm your setups and reduce the chances of false signals. You can add RSI, volume indicators, or any other indicator of your choice. And then stick to high volatility sessions. Okay, focus on trading during major Forex sessions like the London or New York sessions when volatility is naturally higher. And then avoid choppy markets. Okay, if the market isn't showing clear signs of low or expanding volatility, it is better to wait for a cleaner setup. Now, by following these tips, you can increase your confidence and consistency with the strategy. All right, now let's also take a moment to talk about what not to do. Here are some common mistakes traders make when using the volatility expansion strategy. And the first is ignoring confirmation. All right, do not enter a trade as soon as you see a contraction. Wait for a confirmed breakout with strong price action like what we had here. Okay, and then it is bad for you to use poor risk management. Always set your stop loss and calculate your risk per trade. It is also bad to overtrade. Not every period of low volatility will lead to a meaningful expansion. Okay, so be patient and selective with your trades. Avoiding these pitfalls will save you from unnecessary losses and keep your trading on track. All right, and that is how you can trade the volatility expansion strategy, by understanding market volatility and using tools like Bollinger Bands, ATR, and Keltner Channels. You can position yourself to take advantage of significant price movement. Okay, if you found this video helpful, be sure to give it a thumbs up and subscribe to the channel for more in-depth trading strategies and tips. And let me know in the comments if there is a specific topic you'd like me to cover next. Thank you for watching, and I'll see you in the next video. Happy trading.